When you hear the term investment bank, you might picture Wall Street hotshots in suits, making billions of dollars while sipping lattes. But have you ever wondered how exactly these financial giants make their money? Are they simply helping the wealthy get wealthier, or is there more to the story? Today, we'll peel back the layers of the investment banking world and uncover the fascinating, and sometimes surprising, ways they generate profits. First things first, let's clarify what an investment bank actually is and how it differs from your everyday bank. Your local bank helps you open a savings account or get a mortgage. In contrast, investment banks are like the deal makers of the corporate world. They assist companies and governments in raising capital, provide advisory services for mergers and acquisitions, and even trade securities on their behalf. Think of them as financial superheroes, fighting for capital and growth while navigating the complexities of the market. But how do they actually earn their keep? Let's take a closer look at the major players in the investment banking industry. Firms like Goldman Sachs, JPMorgan Chase, and Morgan Stanley are the titans of Wall Street. Goldman Sachs, for example, employs around 40,000 people globally and reported revenues of about $59.34 billion in 2022, with a net income of approximately $11.4 billion. They're known for their prestigious advisory roles in some of the largest mergers and acquisitions. JPMorgan Chase is even bigger, with over 250,000 employees. In 2022, they brought in about $132.31 billion in revenue and earned around $48.33 billion in profit. They play a significant role in everything from commercial banking to investment banking, making them a powerhouse in the financial world. Morgan Stanley also holds its ground with around 70,000 employees, generating revenues of approximately $62.3 billion in 2022. And a net income of about $11.5 billion. Investment banking isn't just an American phenomenon. Firms like HSBC and Deutsche Bank have a significant global presence. When the European economy sneezes, Wall Street catches a cold, so it pays to keep an eye on international markets. But these banks don't operate in isolation. They rely on a complex ecosystem of relationships, including investors, hedge funds, private equity firms, and even venture capitalists. These entities often partner with investment banks for fundraising and deal-making, creating a web of interdependence. It's like a financial version of Survivor. Everyone needs to form alliances to survive and thrive. Let's kick things off with one of the primary revenue streams, advisory services. When a company is looking to merge with another or acquire a competitor, they turn to investment banks for their expertise. These banks provide crucial advice on structuring deals, negotiating terms, and ensuring the financials make sense. For this high-level guidance, they charge advisory fees that can range from hundreds of thousands to millions of dollars. It's like hiring a top-notch coach for a championship team. Only instead of scoring points, they help companies score big deals. While a tech startup may need help with fundraising, a large corporation might seek advisory services for mergers. It's like how a personal trainer customizes workouts. What works for one may not work for another. Take the Amazon and Whole Foods merger in 2017, which Goldman Sachs advised. This massive $13.7 billion deal reshaped the grocery industry and showcased how investment banks are at the forefront of major corporate shifts. So, the next time you hear about a blockbuster merger, remember, behind the scenes, there's an investment bank cashing in on that deal-making magic. Now let's dive into another major revenue source, underwriting IPOs. When a company decides to go public and offer its shares to the public for the first time, it needs an investment bank to guide the way. This process is called an initial public offering, or IPO. Here's how it works. The investment bank steps in to help determine the optimal number of shares to sell and the right price point. They take on the risk by agreeing to buy all the shares and then sell them to the public. For this service, they charge a percentage of the total amount raised. So, if a company raises $1 billion and the investment bank takes a 7% fee, that's $70 million right into their pockets. Think of it as a financial high five. The investment bank gets a nice payday, while the company gets the funds it needs to grow. Next up is trading and market making. This is where things get exciting. Investment banks don't just work for clients. They actively trade stocks, bonds, and other financial instruments on their own behalf. But here's where it gets interesting. Investment banks also serve as market makers. Imagine trying to sell a stock but not being able to find a buyer. That's where a market maker comes in. They buy your stock immediately and then sell it to someone else at a higher price. This creates liquidity in the market, meaning there's always someone ready to buy or sell. And how do they profit from this? They earn a bid-ask spread, the difference between the buying price and the selling price. This might sound trivial, but with thousands of trades happening every second, those small margins can add up to big bucks. It's like running a lemonade stand, buying lemons for $1 and selling lemonade for $2. Do it enough times, and soon you're swimming in profits. Now let's discuss proprietary trading, where things can get a bit risky. In prop trading, investment banks use their own money to trade stocks, bonds, and even complex financial instruments like derivatives. This means they're not just facilitating trades for clients, they're placing their own bets on market movements. If they guess right, they can make a ton of money, but if they guess wrong, it can lead to hefty losses. It's the Wall Street equivalent of playing poker, but with real money on the line. It's a game of high stakes. When investment banks win, they hit the jackpot. But when they lose, well, it's not exactly a fun Friday night. Now, let's shift gears and talk about asset management, a more stable yet incredibly lucrative part of investment banking. Many investment banks manage money for wealthy individuals, pension funds, and institutional investors. They take this capital and invest it in a mix of assets, stocks, bonds, real estate, and more. For managing these investments, they charge management fees, typically a percentage of the total assets they oversee. So if you're a billionaire entrusting your money to a bank's investment fund, that bank gets a slice of your pie, regardless of whether your investments do well or not. Not a bad deal, right? Just sit back, watch someone else's money grow, and take your cut. For banks, this means steady income that's less affected by market volatility compared to trading. Of course, broader economic conditions do play a role, such as interest rates, inflation, or economic downturns, influencing investment banking activities. For instance, when interest rates rise, companies may be less inclined to borrow money, leading to a slowdown in underwriting activities for investment banks. It's like trying to sell ice cream in a snowstorm. Nobody's buying. Now, while investment banks are raking in the cash, let's not forget they also have some hefty operational costs. Running a major investment bank isn't cheap. They have to invest in cutting-edge technology to keep up with trading demands, which can cost millions. There's also the cost of staffing, from highly paid investment bankers to support teams that ensure everything runs smoothly. And we can't overlook regulatory compliance. Investment banks are under the microscope of regulatory bodies, which means they need teams of legal experts to navigate the rules, ensuring they don't end up in hot water. So, while investment banks may seem like money-making machines, they have their fair share of bills to pay too. Let's take a moment to talk about something that has transformed investment banking in recent years: technology and automation. You might picture those classic images of traders yelling and waving their arms in excitement, but nowadays, much of the action is happening behind the scenes. Thanks to high-frequency trading and sophisticated algorithms, many trades are executed in microseconds. Investment banks are investing heavily in technology to ensure they can keep up with the fast-paced world of finance. And with this shift comes even more opportunities for revenue generation. The banks sell their data services, providing clients with real-time market data and analytics. It's like having the best sports stats at your fingertips, except these numbers can make or break a financial decision. While the trading floor may have some old-school charm, today's investment banks are all about that tech life. So there you have it. Investment banks make their money through advisory services, underwriting IPOs, trading, proprietary trading, and managing assets, while navigating their own set of costs and challenges. If you found this breakdown fascinating and want to learn more about the world of finance, don't forget to like and subscribe to our channel, Knowledge Drops. Drop a comment below with your thoughts, and let us know what topic you want us to tackle next. Until next time, keep those financial wheels turning.